When we started talking about a kind of event to put on for New York Climate Week, there were a few factors that went through our heads. As a network, and HFI has been around for 20 plus years now, we tend to operate by two guiding principles, right? One is, as a communications agency, we want to be there with our clients in their most important moments, right? Our job is to help them through transformation and change, to provide advice and counsel. And so that's guiding principle number one. And two, we want to help them develop and support strategies that achieve their business objectives, right? Our job as communicators is to make sure we understand our clients' business goals and we help them achieve them from a communication standpoint. So we started talking about this week and all the activity going on in New York here this week. And if anyone has tried to travel around town, it is virtually impossible between this event and the UN. We thought about a few things with regards to climate week. One is, to tell anybody in this room, ESG has become a hugely political issue, right? It's capitalism on one side. We saw an enormous effort by corporations here in the U.S., particularly over the last half dozen years or so, to elevate ESG into the conversation about how they operate and how they run their businesses. Now it's become a bit of a political hot potato. And it will be a very prominent issue we expect as part of the election cycle here over the course of the next year. And so it weighs heavily on our clients' minds, right? Most of our clients, I think, fortunately, are just as committed to their ESG goals, but how they talk about them has really changed. We've noticed over the last couple of years. So that'll be part of the conversation today. As all of you, I think, know, earlier this year, the SEC started talking about scaling back a little bit, how it was going to deal with climate risk disclosures. And that was another factor that we've been talking to our clients about. That's been in the news even here this week, and I think that'll be part of our conversation as well, too, so that helped guide our discussion a little bit. And at the same time, we've seen some of our states here in the U.S. pick up the mantle and start to push forward with different disclosure requirements. California recently passed some legislation where companies there of a certain size will be required to publicize what they're doing about Scope 1, Scope 2, and Scope 3 emissions. So all of those factors really led us to the question of what does systemic change in this area really look like? And we gathered a panel here today that we think can come at that issue from a number of different areas. So I'm going to introduce them briefly, and then I'm going to get off stage because nobody's here to listen to me talk, and let them take the conversation from there. Our panel will be moderated by Ryan, who is the head of Sustain and a partner at H Advisors Maitland in London. Ryan has really been one of the driving forces around our Sustain practice globally. He has great experience in this area, having advised companies like HSBC, Saudi Aramco, Virgin, Chanel, Burberry, Repsol, and many, many others. There's a very long list here, Ryan. So now I'm going to turn it over to you and let you guide our discussion. Thank you all again for attending. I think there will be some opportunity for audience participation as well. Ryan, guide you on that.
Thank you, Tom. Good morning, welcome. It's so lovely to see so many familiar faces in the audience. So thank you so much for attending today. As Tom pointed out, I help run Sustain, which is our global practice looking after sustainability and ESG. We're really there to help organisations navigate strategy, reporting, media, but so much more. We're really there to help you with your critical moments on your sustainability journey. We have global coverage. We have local expertise as well. We're not one of those firms where we just have a shop where we go into a country and set up with our own views. We've got a really strong model of acquisition, and we've just set up in Dubai in the Middle East ahead of COP28. Thank you so much for some of you who've sent in questions. We tried to incorporate them in what we're going to be discussing today, but at the end there will be a time for Q&A, so please get them ready. First I'll kick off. There were a lot of questions sent in, but there was one kind of dominant theme, and that was about the SEC and climate disclosure. So I thought we'd kick off with Alison on that one. We've been waiting for the SEC to make their announcement, whether they're going to require companies to do Scope 1, Scope 2, Scope 1, 2 and 3, and it's been delayed. However, since then, as Tom alluded to last week, Governor Newsom said that he's going to sign the Climate Disclosure Accountability Act, which requires all companies operating in California with a revenue over $1 billion to report scopes 1 and 2 and 3. So I thought the first question is, how will this new California Act impact what the SEC ultimately does in this space?
I think in a number of ways. So I first thank you for having me. It's a pleasure to be here and see all of you, and I hope we can have an interactive discussion, because I would love to hear from you. I've already learned tremendously from my panel members just in the discussions we had in the we were waiting. But oh, okay, sorry. I always have this problem. I have this problem with juries too. So let me, please just wave your hand if I'm not speaking loud. All right. So I think it will have an impact, and I think it will have a pretty profound impact in two ways. First, as many of you know, the SEC is required by law under something called the Administrative Procedures Act to do an economic analysis of how its rules will impact. And that means you're weighing the costs and the benefits of the rule. It's an inexact science, and the agency digs through mountains of data. We have an entire division whose job is to do that. And SB 253, meaning, which will now require companies, as you mentioned, of a certain size, to report scopes 1, 2, and 3 for companies that do business in California. That's going to capture thousands of companies. Many of those companies are going to be U.S. public companies that are already in the system. So what will happen to the baseline economic analysis of the SEC is that's going to lower the cost side of that equation. Because they have to say, what's the state of nature right now in this particular market that we're going to regulate? And when the answer is already some thousand number, or I don't know what the number is, but we're working on figuring that out. And by we, I don't mean the SEC, I mean me and some of my staff. But the answer is that's going to change the economic equation quite a bit. The benefit side, it is what it is. It's harder to quantify in many ways than the cost side, but the cost side is now going to go down. And that is our central the challenge that our rules face. And excuse me for the pronouns. I was there for 17 years, so I have to stop saying we. But and I'm not speaking on behalf of the SEC. Let me be clear about that. But the central challenge that the SEC faces with these rules, and the one that is the most common legally, is a challenge under the APA for having done an inappropriate or improper or incorrect economic analysis. And again, that's a difficult equation it's a difficult balance to strike, but this is going to tip the scales in favor of scope 3. And I think as Ryan alluded to, the rule proposal that's out there right now would require scopes 1 and 2 from all public companies, well, all large accelerated filers in public companies, and scope 3 from the same group only if it's material. There's a lot of talk that last piece might get pulled out, and that's just pulling the rug out from under, which we can have a different discussion on that. And so this will at least put, I think, a little bit more wind behind the sails. And I don't know if I should go, I don't want to go too long, but there is one other potential impact. And for the lawyers in the room, I know many of you are familiar with the major questions doctrine. And it's a relatively new-ish doctrine, depending on which scholar you're speaking to. In my own view, it's brand new. And there's very little precedent out there on it, and it can be used by the Supreme Court to basically do whatever they want, consistent with whatever they think is the best policy, let's say it that way. And we all know what the balance of power is on the U.S. Supreme Court right now, and we know it tilts against potential regulation in this space. What will happen, I think, with 253 is the justices will all know that if they strike out the greenhouse gas emissions portion of that rule, or the rule in its entirety, or wherever they land, they'll know that there's still going to be a lot of U.S. companies that still have to report scopes 1, 2, and 3. So that will be in their minds. And for better or for worse, I've talked to plenty of scholars, constitutional scholars in this space, who say that they are going to want to use this doctrine advisedly and not consistently, because they are aware of the critique of the court. They're aware of how it looks that it potentially looks like they're sort of making policies based on their own agendas, And so they're going to want to selectively use the doctrine instead of just constantly using the doctrine. And maybe this is something that will put a thumb on the scale. Again, that's speculation, but those are two ways, among many, actually. I just want to highlight those two. So let me stop and see if others have thoughts or input. I know we have one other lawyer on the panel, but there's also lots of political implications here as well. So.
Fascinating. Thank you. Sophie, when you're making investment decisions, how important is an organization's decarbonisation strategy?
So, just so you know, I work for an asset manager. We manage 35 billions of assets. We operate mostly in Europe, but we do have offices in 10 countries, one in New York, and we do invest also in the United States. So we are a listed company. So for the last 12 years, we've been doing a very detailed ESG reporting, not only scope 1, 2, 3, but also all sorts of data, and not only on Eurazeo, the asset management company, but also on all the assets we finance. And today we have 550 companies in our portfolio worldwide. So we do have some American companies that we finance and that are delivering a very detailed ESG reporting based on European regulation, and it does work. And as a matter of fact, it's more a benefit driver than a cost driver, and that's probably something we could discuss. So to just setting the scene, because regulation does matter, but the way we are looking at it is. When we invest in a company, we want to know if the company is going to be future-proof. So we do not invest in listed market. We invest in companies which are not listed. So in France we call it the real market, but it's more a scheme of language. And probably at the contrary of what people believe in finance, we are not short-term. We work in a 20 years time frame. Why? Because when we invest, we're going to be holding the asset for 5 to 7 years. We need to exit. So if we want to exit successfully with a nice multiple, we want somebody to find the asset attractive. And somebody to find the asset attractive, they need to see themselves reselling it as well. So that's at least 3 times 5 to 7 years. So we work 15 to 20 years from now. So the job of my team and myself is kind of having a crystal ball. What is the future going to look like? What is good going to look like in 15 to 20 years from now? In Europe, so we do have some questions as well about the regulation pass yes or no, but we're working on a very strong hypothesis that regulation will require to decarbonize by 55% by 2030. We already have a regulated carbon market. Which has been operated since 15 years now. Maritime transport is newly regulated with carbon tax. So we do believe that carbon tax should expand, especially governance and countries need money. So, it's a nice way to get money with taxes that are swallowable. So to get back to your question, Ryan, when we look at the economical model of a company, we look at it and say, is this future-proof for all supply chain, climate reason, whatever, but also consumer demand? So will the company still be acceptable in 15, 20 years from now? And, that's a key question. And also, can the company afford its decarbonization if it is technologically feasible? So we try to forecast the OPEX and CAPEX investments which are required to divide at least by 2 the carbon emission of a company. We've been doing that for heavy emitters, 200 million of investment in 4 years. So, not every company business model can swallow that type of cost and remain profitable and remain competitive. So, and with this economical model, we try to see if yes or no it's going to happen. Of course, we factor in technology, and it's very clear for us, if a management team tells us sustainability is not in the equation, we will stop discussing with them. The reason for it is we believe they are making a strategic failure. because sustainability is everywhere, climate shocks are everywhere, so if they're not factoring it, they're just not good strategists, so we don't want to work with them. And then we look at how prepared the company is, and if they're too backward, transforming their product, transforming their operations, we won't go there because we won't be able to afford and complete the transformation at speed. So it has come at the very top of our investment decision, and there are quite a long list of assets which we didn't finance because of sustainability issues.
Thank you. Monique, supply chains make up a lot of your greenhouse gas emissions, right? How do you start engaging with suppliers about this?
Yeah, it is a lot. So in my sector, food and beverage, generally the majority of the impacts are in the supply chain. For us, our scope 3 emissions, which is total value chain, both up and down, is 96%. But if you look at our total carbon footprint, sourcing alone, so just those supply chain activities where we're buying things, is 76% of our impact. But we're not just buying one thing or one category of things. So if I take a little bit of a step back, you have to understand the context of who we are and what we're doing. We're a new company, so Keurig Dr Pepper, 2018, it was a merge between Keurig Green Mountain, so a coffee systems company, and Dr Pepper Snapple Group. So the result of that merger is what is now a $14 billion diversified beverage company. We offer over 125 different beverage brands that are either owned, licensed, or partner brands. We manufacture at 30 facilities in the US, Mexico, and Canada. Now, why that context is important is because those things, the materials that we buy, those fit into 3 broad categories. First would be ingredients, mostly agricultural inputs to our products. The second is third-party manufacturing. And then the third, just a little behind those two, is packaging materials. So those last 2 categories, they're manufacturing oriented. The levers that you're pulling in terms of supplier engagement when you get to that prioritization, they're pretty clear cut. It's measurement, it's management, and it's reduction of emissions, and those reductions come in the form of efficiency and design or choices that we're making. So a great example and one in which there was a lot of supplier engagement and process was the conversion of our Snapple brand from glass bottles to PET, and not just PET, but it was the 100% recycled content. So there was a significant reduction in emissions throughout that transition, both from a material and a transportation point of view. So not simple, because no one wants to say simple on scope 3 engagement and supplier engagement, but the levers, like I said, are very clear cut. That ingredient bucket, that's where things get really complicated, because there are oftentimes intermediaries in between where we sit as the beverage manufacturer and the agricultural fields where these crops are being grown. And coffee is a great example. Coffee's very close to my heart. We've been working for decades with coffee farmers on what decades ago we called climate smart agriculture, now is called regenerative agriculture and has a few nuances to it. But that engagement is really not just focused on emissions reductions, but on resiliency. And coffee is a great place to work on resiliency because the impacts are not in the future. The impacts are here and real and now, and we are losing significant land to be able to produce coffee going forward. So that supplier engagement is with coffee farmers, it's with cooperatives, it's with traders, it's with government agencies, nonprofits, and it's very, very multidimensional because of the scale of change and impact that needs to happen. And it's not just about quantifying numbers of greenhouse gas emissions and putting them on a page in a report. It is about action and is about impact. Apples is the last example I give you in terms of supplier engagement because it's another one that's near and dear to my heart. But apples for us is actually an agricultural product that we buy directly, no intermediaries. Very special to us. We buy apples from farmers in upstate New York, and they don't touch anyone else's hands. They go straight into Mott's applesauce. So the supplier engagement there is not even as nuanced because it can be a direct conversation with farmers around what agricultural practices are happening, encouraging native pollination, which seems a little bit tangential, but actually really important for sound environmental practices on the farm and sustainable practices going forward. So the supplier engagement, we highly prioritize because of, yes, that 76% impact within our footprint, but it's very nuanced and it's about long-term, not about short-term data collection and reporting.
Thank you. So we're hearing long-term as a theme here on the panel. Talking of long-term, Dana, offsetting gets a bad press, but actually it's crucial for overall climate mitigation. How do you approach this, and what role do carbon markets play here?
Yeah, thank you. I hope I'm loud enough. If not, let me know, but usually I am. Okay. So the carbon markets, which is the markets by which mostly corporations buy and sell carbon credits, also known as offsets, do get some bad press. And I really thank you for framing the question that way, because they are crucial and really can be crucial in the overall fight against climate catastrophe and keeping us on a 1.5 degree pathway. So the carbon markets can deliver up to 30% of the overall climate mitigation needed globally. And I think in order to explain that, it's incumbent to understand exactly what they are. So let's talk about corporate decarbonization strategies, of which I am not the foremost expert on the panel, but I know something about, because Flowcarbon works very closely with corporations on their decarbonization strategies, and in particular on their procurement of carbon offsets and their construction of carbon offset portfolios. And so what corporations do now, what they have to do, what they are actively doing, what over 6,000 companies are doing pursuant to the SBTI, which is the Science Based Targets Initiative, is making a clear public commitment to decarbonizing. If they do it pursuant to SBTI, which is what 6,000 global corporations have done, then it's a very clear formula, but it's a formula that you can follow even without an SBTI commitment. And it goes like this. Number one, quantify your emissions, quantify them across scope 1, 2, and 3 being very challenging. After you've quantified, start identifying decarbonization opportunities. And we talked about the fact that in every organization, there are the low-hanging fruit decarb opportunities, and then there's the much more difficult work to do. And so you do it on a time scale. Many companies have a time frame that goes till 2050 to achieve net zero or to achieve some other target that they've set. But so you start doing the really difficult decarbonization work, which is unbelievably complicated. But in the meantime, you have hard to abate residual emissions. As you start decarbing, you have emissions, and you will at the end point, because every company on Earth is going to emit carbon. And so that's where offsets come in. Your options are do nothing about the residual emissions that you inevitably will have and will have on the pathway, and then when you get where you're going, do nothing. Or buy offsets, which when the offset market functions the way it's supposed to, is a mechanism for paying for carbon abatement that happens completely outside of your operations or your supply chain. And so now let's understand where offsets come from, which is by far my favorite topic. So the supply side of the market comes from carbon offset producers or creators. Now, who are they? They are a whole amalgamation of projects, global projects across the world, that are engaging in carbon reduction activities, which means avoiding emissions. So they're doing things, and I'll get to specific examples because this sounds abstract. They're doing things that prevent emissions from happening in the first place, that are very likely to happen if this project didn't happen. So think large-scale environmental conservation of threatened land. So you have land that is actively threatened, it is going to be cut down, and if somebody steps in and conserves it, they are preventing those emissions from happening. On the other hand, many projects have an actual net removal capability, which means they're actively removing carbon from the atmosphere. Think trees or think machines, both of which suck carbon out of the atmosphere actively. And so there are projects all over the world which are projects, right? If somebody starts planting trees, that's a project. When does it become scalable? It becomes scalable when you can make this project or this hobby ROI positive. You could make it, in some ways, a business. You could make it something where the economic incentives are to do that project rather than to not do it. And so the way to do that is to allow that project developer to have a revenue stream based on what they're doing. And so that's what the carbon markets are. Fundamentally, they are a mechanism for allowing private capital in the form of carbon credit buyers to finance these incredible activities that are happening. And so a great example that I use is a stat that I heard, which I heard it, so don't quote me on it, which goes like this, but it's from quite a reputable source. A hectare of old growth rainforest land in the Amazon, to purchase it, is worth something like $200 US. You could buy a hectare of old growth rainforest, some of the most carbon dense and biodiversity rich ecosystem on Earth. When you clear cut it, you slash and burn it, its economic value goes up to over $1,000 US. That's when it becomes valuable. What does the carbon market do? It has the effect of this. You can put a fence around that hectare and conserve it, and then you can have carbon credits issued against that activity in exactly the amount of carbon that you have now sequestered in the trees in your hectare. And then you can sell that for revenue. And all of a sudden, you have an ROI positive activity that stems from the conservation activity rather than the clear cutting. That's when the carbon markets work. And when offsets work, that is the kind of thing that they are producing and that they're bringing about. Same as with direct air capture facilities. So technology-based removals projects, they get a lot of buzz and they're phenomenal. We work with a lot of those developers because on the supply side of the market, Flowcarbon is actively financing projects. It is, if you want to build a direct air capture facility, that's a hobby unless you can generate revenue based on that activity. How do you generate revenue? You get carbon credits issued to the carbon removal activity that you're doing. You're building a facility, it's actively sucking carbon out of the atmosphere, that's being quantified, you're being issued credits against that amount of carbon, and then you need to sell that. And that's where your revenue comes from. Without that, nobody's building direct air capture facilities. We're not going to suck carbon out of the atmosphere. And so that's where the carbon markets play a key role in financing this whole ecosystem of amazing projects. We just focused, of course, on the carbon benefits of these projects. There are tremendous other biodiversity and water systems and food systems benefits. But that's the role that carbon markets play when they're supposed to. I'm definitely not going to sugarcoat it and claim that the markets don't have a lot of improvements to be made on the measurement and verification of the projects that are happening, for sure. That's a given. That work is happening, which is phenomenal. And it's why these markets are expected to grow dramatically, and it's why so many corporations are engaging with this market. I'll just close with one stat, which says that there's a lot of research that's coming out now, very recently. It's like 6 months old, this research, showing that the corporations that are buying offsets, that are engaging in the offset market, on the contrary to being those that are greenwashing, those are exactly the corporations that are by far the most committed in a demonstrable way to decarbonizing. So there's a direct correlation between the most climate positive and carbon responsible corporations who are decarbonizing and those that are buying offsets.
Thank you.
If I may, because you've said several times when the carbon market is working.
Yes.
And that's a huge caveat. So I invite you to read the Guardian study about what is happening right now with carbon offsets. And as much as I work in the financial market, and that's a job, and I build financial products, and I build impact financial products, I urge you to be very cautious when going into what are nature-based products. Nature is a common good. We do not want to spread all the financial, I would say, schemes that we may see in something that is such as important as a common good, which are the carbon thing. Nature-based products are very fragile. Nature products are very fragile. There has been a lot of speculation on carbon, very limited revenue going effectively to the population, And we have right now a huge pricing issue, and I'm sure we're sharing that point. So each time you see a low-cost carbon offset, you should run away from it, because that means it's poor quality, limited additionality, and probably the people who have to sell it for such a poor price are starving. So it's not easy to make revenue out of nature-based projects. That's the first thing. About carbon storage, again, there is a lot of press buzz about, some magic vacuum cleaner of the atmosphere. If you look at science and if you do the math, I mean, it's going nowhere. So we are putting millions and millions in projects which are going to capture less than 0.00001% of the carbon that are at stake. And most of carbon storage projects are used by fossil fuel companies because they use the carbon to fuel it into their facilities so that they are going to improve the productivity of getting the oil or the gas outside of the soil. So again, as much as I do agree that we need carbon capture and we need carbon offset, it's a very complex market and we need some very trustworthy partner, because first of all, the first good carbon ton is a carbon ton which is avoided. It's not a carbon ton which is offsetted. And if you guys want to go to offset, you really need to consider, should I put my dollars in offsetting or should I put my dollars into transforming my operations? And you were saying, Monique, how complex it is to transform operation. I mean, it's a huge change that we need to carry on. So that's the first question. And, working with so many companies, I'm a clear advocate of let's transform first and compensate at the latest, but we do need compensation. And if we buy compensation, for example, at Eurazeo, we buy credits. We do not talk about it, and we solely buy high-cost local project credits. And we are sure we go on the field and we make sure that the population are benefiting from it. So again, we need those markets, and of course the solutions you're bringing are to enhance confidence in those markets, but this is not magic, and rules of market are not going to create a fairy tale market just like it didn't, on subprimes, for example. So let's be extremely cautious, because again, it's a common good.
Can I also just say one, and I'm sure you want to respond to this is not, I really just want to bring a regulatory lens to this.
Yeah.
Because one of the things I think about, so I'll start with this baseline. I completely agree as well that that is an extremely important market, and what you're doing makes a lot of sense, and it's needed for a lot of reasons. We could talk about the timelines and when when any particular thing makes the most sense. Here's what I think about though. It needs to scale. You mentioned this, right? But it's not really very well regulated. So can you take a market that is not well regulated and scale? We saw that with crypto. And I'm not trying to say that crypto, I'm not trying to draw an analogy other than on the regulatory piece of that, right? So I too think that market is important, and I think it needs to scale, but it needs to be, in my view, arguably unbiased, and I've spent years as a regulator, but I have not seen a market do well and scale in a way that actually makes sense and makes money that isn't well regulated, and that's the piece I think I would love to see some focus on while we watch this market grow, this important market.
Yeah. First of all, I love this. When panels end up with actual engagement among panelists, it's the best panels. So kudos to you for putting this together. I agree with everything that was said. So for starters, what's really important to note is that this year, this is a $2 billion market, and that's a banner year. 2 billion, you're all professionals, a $2 billion market is barely a market. So for starters, nobody's made a lot of money in this market. It's a tiny market. It was $500 million 2 years ago. And what that means is, it was barely a market. Nobody was actively focused on it. It got a lot of press because, The Guardian focuses on it. But other than press, nobody else was focused on it. Regulators were not. Investors were not. Capital providers were not. A lot of technology creators were not. It was a bootstrappy, market of environmentalists trying to do the best they could. There were definitely those, when you have a sort of small, nascent, unregulated market, people come in and do things you don't want them to do. So this market is just getting started, and I fully agree. It can only scale when it is fundamentally a market of high integrity, where you know that the credit that you're buying, which represents a ton of carbon, represents a ton of carbon that was either removed or reduced. Now, on the regulatory front, so I hosted a conference, my company hosted an all-day conference yesterday. Sophie spoke and was phenomenal on her panel. And then I did a fireside chat with Chairman Rustin Benham of the CFTC. So we spoke for 30 minutes about this market. The CFTC is very focused on voluntary carbon markets, recently announced that they would be using their anti-fraud and anti-manipulation authority to regulate the spot carbon credit market, which is phenomenal. It means that they're doing exactly what you said. They're actively policing for fraud and manipulation in the market. They issued a whistleblower alert a month ago asking for whistleblower tips. So they are actively stepping in, as the chairman made clear yesterday, because they view this market as a key component of overall climate mitigation strategies. They know that tons of corporations are getting poised to participate in the market. And B, because they know that in order for it to scale, they need to step in. So fully agree, and it's happening, which is phenomenal. And it's a sign of the market's maturation. But it's, Sophie, everything that you're talking about is true and is needed. And it's really just because of the market's nascency. It's tiny. Now you have investors the capital is flowing into the market. You have tremendous technology innovation, which is being brought to bear, which means venture investment funds backing startups, which are creating technology, which are monitoring projects, using drones to watch tree cover, so you can't pretend that the forest you conserved is there if it's not really there, and you can actively see what's happening in real time. All kind of remote sensing devices, all kinds of technology removal capabilities, which, by the way, nobody's going to fund if they're not scalable. So I agree with you. Nobody should be throwing billions of dollars into non-scalable tech removals products, but the equity investors are going to deal with that, right?
We are, as a matter of fact.
I know, exactly. Exactly. So I agree, and it's all happening, and there's so much work that needs to be done to improve these markets. And yes, stay away from really low-priced, old nature-based credits that you may come across.
Thank you. I'm going to open it up to the floor now, because I've been told that everyone's gagging to ask some questions. So if you have a question, could you please just raise your hand and I'll come to you if I can see just a gentleman here.
Sure. Thanks very much. That was very, very interesting. I like to think about also the regulations differently between the European Union and the US. The challenge I see as well is if internationally we're not aligned in terms of incentives, there are challenges. So I see in the US there's a lot of the SBTI Scope 1, Scope 2, Scope 3 emissions that is going on right now, which I think is very exciting. That being said, a lot of companies now that have done this do end up with the reports where Scope 3 is 90+% of emissions, and I'm afraid we're still deferring the problem in that scenario. In Europe, we see that we have a bit more alignment in incentives with the carbon taxes, but that is almost punitive towards Europe because we're taxing our companies for carbon, while the US or China, where the biggest emitters, are still not doing that. So is there a way we can find an aligned incentive that is a bit more international, I would say? And yeah, I'd love to hear all your thoughts about it, especially. Yeah.
Thank you. Alison, do you want to take that one?
Sure. Here's a term that we stress. I know if anyone covers it, it'll be like that. But I regard right now the U.S. as an international laggard in this space, and I'm not comfortable with that. And so I think your point is well taken, because not only is it the case that we need to coordinate on this global issue, but it does misalign incentives in a way that punishes the folks who are actually doing the work. What I hope and expect that you will see is the SEC catching up with its final climate rule, anyone in this room who thinks that climate rule should have scope 3 should need your voices heard now, because I think it's in danger, and I think it will make a massive difference, because it is the majority of emissions across the globe. For the major emitters, most of their emissions are in scope 3. If we just say, only show us the iceberg that's above the water, what have we accomplished? And we will have, in addition, created worse incentives for what's happening abroad. So I'm in agreement with you on that. I do think it is at risk. And we have, as you know, a very volatile political environment right now, and next year is an election year. The temperature is just going to go up on these issues. Right now, honestly, the polling around this anti-woke, anti-ESG is not doing what I think some of the politicians were hoping it would do. So what I hope we'll see is a bit of a receding from that, but I think the temperature may go up as we get closer to an election. I wish I had a better answer for you, but that's my 2 cents on that.
So maybe to take another angle and I completely share your view, and probably Monique, you can also elaborate on that. I trust very much that regulation, might even become an obsolete topic of discussion because of what's happening out there. And I was very happy to say that, there is a big lawsuit starting in California against fossil fuel companies. And as we were discussing this morning, I was saying it reminds me of what happened with the big tobaccos, and it raised an international awareness about the fact that, yes, it was bad for health, even if doctors have been paid for decades to say, no, it's good for you, and you can still see old ads saying how beautiful it is to smoke. So for me, it is states, consumers, companies taking their destiny in hands. And the thing is, you cannot beat the physical world. And when we are talking about disclosure, which are scope 1, 2, 3, but it goes far beyond that. We need also to take into account the entire planetary boundaries on which we are working. But at the end of the day, I was at a round table with a minister of Bermudas, and he was saying we can't pay back our debt because we're facing our third hurricane. So you cannot beat the physical world. So at some point, what about disclosing? It's going to be massive amounts of money that needs to be paid. Company like yours, like ours, we want to protect their license to operate. So whether we have to disclose something on top of, it's going to be about, adapting and to some extent survival. And I guess that's where we're going to get the alignment, because the physical world is really, really kicking in and much faster than we were expecting. In France, if you can hear that I'm French, we are already plus 2.4. So it's plus 2.4. And in real life, we have some companies, for the first time this summer, we are so proud to have some beautiful water brands like the Volvic, Evian, and for the first time they had to withdraw from markets because there is not enough water available to sustain their growth. So it's not going to be, there is a lot of debate about growth and all that kind of thing. Physical world is kicking in. So when the physical world is kicking in, we need to adapt, and probably regulation is going to be a bit late, but the physical world will remind us of what we need to do.
Thank you. Yes, sir.
I have a question for you both. So I'm Louis from Uptel, so we are doing LCA and carbon tracking on complex supply chain. So we have customer in the coffee supply chain, and so the coffee farmer have to adapt their agricultural practice because a lot of the scope 3, a big part of your scope of the coffee supply chain come from the farming practice. So how can we help farmers financing this transition with carbon credit? Because they might have to buy a different type of fertilizer, ammonia-based instead of nitrate-based. So could it be used to help smallholder around the world and farmer to make this transition to regenerative agriculture?
I'll just repeat the question to everyone here. So please correct me if I'm going wrong. How can we help farmers transition
With carbon credit?
with carbon credits?
Yeah, that's exactly the use case for the carbon markets. So you have small farm holders who start implementing regenerative agricultural practices. Those are expensive. They require behavior change, no-till farming, open grazing, if they're in grazing, meat producers, etc. That's expensive. So what they do is they implement those practices. They then submit the evidence of what they're doing to one of the global carbon credit issuers. The issuer, you go through a third-party independent verifier. So independent verifier, global carbon issuer. If everything checks out, they get carbon credits issued to them, which they can then sell to corporate sustainability teams as offsets. And that's exactly how it works. And that's how, when they sell it, they get revenue. And now they have a viable business model to support their regenerative ag transition.
I would just add that it's, in a perfect world, that's how it would work.
Yes.
But the reality too, and then the gap between reality and perfect world, is that the majority of our coffee farmers, for example, are smallholder farmers with less than 2 hectares. They're not sophisticated participants in a global carbon market. And so there's a lot of intermediaries, even in the development of what you're describing, that would have to come to play. It's been in dialogue. We're talking for a long time. You know, we've had people coming to us for a long time talking about insetting and offsetting activities. Where we have decided to stay for now is in directly working with those farmer and farmer groups on the regenerative agriculture practices and to watch and participate in the maturation of these newer options. And I go back to something Sophie said a little bit earlier around, you know, the choices that we have to make between decarbonization plans, direct decarbonization plans, and then offsetting. And you know, where we find ourselves at this point in time is a lot of opportunity still on the decarbonization side that we need to keep very focused on and keep delivering on. And again, while we continue to watch and understand where the carbon markets are going.
Yeah, two quick things. Not to take up more time, but one, for sure, there are a bunch of platforms that are aggregating smallholder projects. That's obviously something that needs to happen, and there are businesses that now are aggregator platforms for smallholder farmers to band together and get carbon crediting. And then second, offsetting should never be at the expense of decarbonization, for sure.
Great, thank you. Yes.
So I think Sophie brought up the concept of future-proof companies earlier. And so I'd just love to kind of hear from all of you about how do we really future-proof this space, right? From a corporate perspective, carbon markets, regulation. As the climate change is made very difficult, right, to actually grow in a capitalist society while still trying to minimize the environmental impacts that we have, right? So like, what does future-proofing really mean? And like, how do you think about that?
That's such a wide question. We could keep that. You could come up with something quite quick on that.
Yeah. Well, my quick answer would be a balance between these reduction activities and the resilience. I described why resilience is so important to us from an agricultural commodities point of view, but we also see it in the manufacturing supply chain and our own supply chain as well. So it is a balance between those two things. And then I think the other is a balance. We've had a lot of discussion around regulation. And regulation needs to be a part of the solution set, but it needs to be informed. And the example that I'd provide there is one of our biggest challenges. 46% of our scope 1 and 2 is our fleet. We own our own direct store delivery fleet. So many of our peers, that's in their scope 3. It's not for us, it's scope 1. And that is heavy trucks delivering really heavy beverages. So there is not at scale available and affordable right now the trucks that will facilitate that. You hear a lot about decarbonization of fleets, but that it's really focused on passenger cars, not on heavy truck. So future-proofing for us is finding that right balance between smart regulation, technology development, infrastructure development, grid capacity. It's a huge puzzle. And so this partnership mentality that you can bring to the table and constantly casting about for the smart partners who are looking towards the future, who are investing in the future in smart ways, and staying at it for the long term. Going back to that, there are not quick fixes, but it has to be a partnership approach.
Right, thank you.
If I may just share one word with you, is for me, it lies in biodiversity. Resiliency is related to diversity. And when we look at companies, future profitability, is going to be specific company by company. One ingredient that you can find in common is what is the effective contribution, usefulness of the company to society. And I guess that the more we move along time, the more we will need, to be useful, and that products which are, just for fun of it, even if it makes life nicer, probably will become dispensable. But at the end of the day, if we really want to be future-proof, we need to be diverse. And that's very much in line with what you're saying, Monique, about resilience. How can you be resilient? You need to be diverse from a geographical standpoint. You need to be diverse because then you have various regulations, for example, and you can run from some other and not be present in some other geographies. You need to be diverse. You were mentioning your Apple supply chain. How do you make sure they come from sufficient region, but also sufficient variety of species? Because if you have an illness to a species, you need to make sure another species is going to be, kicking in. So I really believe there is a lot of research about mimicking nature, and I believe that diversity is the key.
I have to just say one thing. From a regulator's perspective.
Not winning here.
I will be very quick. And here's the point, because when you said future-proof, I wrote that down. But what I heard also was 15 to 20-year horizon.
Yeah.
So think about that in the U.S. I was just on a panel at Carbon Tracker on Monday with a fund manager who said, I have quarterly numbers I have to meet. And so the difference between her 15 to 20-year horizon and the fund managers in the U.S. So markets run on financial incentives, and there's a massive tension there that needs to be addressed.
Great point, thank you.
Yep.
Yes.
So my question actually is an amalgamation of the apple farming and the investors, and it's actually just wondering, so supply chain management, how do you ensure sustainability? And we'll go to the agricultural example. To do things sustainability takes more time. So you're not getting the product more quicker. So how do you balance between investor price, sale price, and sustainability? It's a big question.
That's a good question. Just practically speaking, I think one of the ways that we approach the holistic formula within the company is making sure that all parts of the company are bought in and participating. And the Apple example is a great one. So the investment in apple farms on the ground, be it bringing in native pollinators or looking at cover cropping in a different way, there's a story to be told there to the consumer, and thus an appeal to the brand as well. I mean, just simply that transactional piece of the apple going from the tree straight into the apple sauce is a great story for mom, right? It's also a great carbon footprint. I mean, there's different angles that we can tell. And one of the conversations that we had in the room prior, there was a comment thrown out, and then we just hope that the consumer makes the right decision. And consumer brands especially have a great role to translate that hope into reality. And so translating the hope into reality is also selling the product, which is really one of the biggest things that we can do to deliver the value to our shareholders as well, and to continue to grow. So if we don't have brands participating, our supply chain managers participating, yes, the sustainability, the transportation, I mean, everyone kind of marching forward on the same plan, that is a growth plan for the company, a growth plan for the brands, but it's sustainable growth that's going to protect us for the long term as well.
Maybe to go to your question, I love to make an analogy with the tech transformation we've been facing, for the last 20 years. And sometimes, maybe we're too impatient and we would love to have things happen overnight. And, as you were saying, carbon market, it will take time to structure. And you were saying it will take time to regulate, it will take time to implement with the farmers. And if you look at the digital transformation of commerce, for example, well, all of you, you're probably digital natives. So I'm a dinosaur, so I'm not a digital native. And, when I was young, I was going to stores. And then, many companies had to transform, to embed digital tools. And at the beginning, it was a cost center. It was not a profit center. But over the years, it has transformed. It has been, embedded into business model. It has been embedded into consumer habits. It has been embedded in the way we produce, we operate, we think. And now it's working well. And I believe you're taking the route to a regenerative circular economy, which is the changes which are taking place right now. We are moving from predative linear to regenerative and circular. And it will take time. But I would say the only question is, how much time do we have? And climate is kicking in, so that's the worry we have. But we need to allow transformation to take place, because when we manipulate, when we work with plants, when we work with soil, it takes time to adapt habits, to find new habits. And I don't think, that order was a greater, or that innovation is going to save us all. It needs to be, a blend. Again, diversity of solutions that we can implement, hopefully in a timely manner.
I think the biggest, oh, sorry.
Sorry, I've got to move it on. Apologies. Well,
Thank you for this. This is great. But my question is for probably Sophie and Alison. What would be your elevator pitch to the company that, based on its business, believes it has time because it's a low emitter, and so let's let those companies across the globe that are these, greenhouse gas emitters, let them fix it first, because we don't have to step into the conversation just yet.
Yeah, well, the thing is, the way regulation is set in Europe, so I'm going to answer from a European perspective, and Alison, it's great we can complement our vision. Heavy emitters have been regulated first. So, we have the carbon tax for heavy emitters, and that makes sense because at some point, we need to prioritize. At the end of the day, when we are looking at the magnitude of the change, and when you're talking about the carbon market, we see the magnitude of the change. In Europe, all companies will have to divide their emissions by more than 2. And I do still see it as a transition phase, because at some point we will have sufficient benchmark and we will be able to say, okay, this cider bottle or, this drink, it's like the calories. If I tell you this drink is 100 calories, you immediately know if it's a lot or if it's not a lot, and if it's good for you and if it's not good for you. So what's taking place right now in Europe is a foundation of having those data. This is where reporting is important. And we will have this mental scale of, it's too much. I won't put my money in that. It's not too much. So I believe, in my opinion, we know that through for example, a small gesture, we can impact by 5 to 10%. This has been measured. It's based on scientific data. So all of us in the room, by the way we act, we can impact 5 to 10%. So for me, everybody needs to do what they have to do. And especially the low emitters, often it's going to be easier. So, just tackle it and get the benefit of it in the marketability of your product. For me, it would be a waste of opportunity not doing it.
I'll answer very much more without as much depth as Sophie has, but thinking about it from a market perspective. And here's what I would say. So first of all, if you're a low emitter, great, right? Make sure you're authentically analyzing your risks and you know where you are in that life cycle. But secondly, this is an index economy in the U.S., an index investing economy. And what that means is that investors across the board, so if you're a U.S. public company, investors across the board, most of us, myself included, have exposure to the entire economy. And so that's because that's what modern portfolio theory has driven us all to. So that means they're just as exposed as the rest of us are, right? We're all in this together, whether we like it or not. And people are not looking at those firms and saying to themselves, I have some money, should I invest it or not invest it? That's not what they're doing. They're investing their money across the board, and the impacts are falling on all of us. So they're in the game, whether they know it or like it or not. That's my elevator pitch.
I think we've got time for one more question. I'm sorry, I can't see around the corner a little bit. Is anyone?
I got a question to what Alison just said, actually, is that I've thought about this a lot. You know, a lot of our investments are tied in fossil fuels, right? You know, pension funds, schools, endowment funds, personal finances, right? How do we decarbonize? You know, I get that's the idea of the just transition, right? But it's like, how do we actually make that happen, and how do regulations come into play to make sure that the economy is not at stake? If these companies are to just shut down tomorrow, right, which a lot of us would maybe, idealistically hope for, it's just not realistic from a market's perspective or from a global supply chain perspective, right? How do we ensure that that doesn't just collapse over time? What? Sorry, really heavy.
Yeah.
Really easy question.
Happy I think, so there are a couple things embedded in that. There's the sort of exit versus voice dichotomy that investors face. And there's a range of views on that. And I think reasonable people can differ on the right approach there. My own view on that, after a lot of thought and discussion, is voice makes more of a difference, especially in the public markets where it's very hard to move the cost of capital by exiting. And so you got that on the one hand. The other piece that I would say there is the entire reason I took this on as, in my role as a commissioner at the SEC was because I can foresee a disorderly transition. It seems very obvious to me that that is a massive risk we face in the US and globally. And so the only way that I can see is how can regulators add value to sort of reduce the chances of a disorderly transition, like what we saw with subprime. In this space, it's very foreseeable. So I think, again, from a regulatory lens, regulation, and I don't mean overly burdensome. I'm not saying, it sounds like when you're a regulator, you're a hammer, everything looks like a nail. I have thought a lot about where they can add value. And in my view, it's transparency and accountability.
Right.
And maybe if I can just make, for example, at Eurazeo, we have an exclusion policy. So I manage the exclusion policy. I'm the sustainability officer, and the thing is, a lot of people ask me, "Oh, what is this exclusion policy? Is this your belief? Like, are you an activist?" And yes, I'm an activist against stranded assets. Okay, so I'm protecting the fiduciary value of our investors by trying to forecast within this. So of course we're not a listed market, we're on private market, so we have more time, but we're trying to forecast where are going to be the huge value loss. And looking at that, and when I discuss with our customers, I explain to them, our exclusion policy is your shield against stranded assets and reputational issues. So it's not an activist view, it's a very realistic view of the economical market, of what consumer wants, do not want. And going back to pensions, I don't know how it operates in the States, but for example, in France, we can opt for the product in which we want our pension to be invested. And you guys may have the choice, to decide to blend your portfolio. And so, for example, for the last 20 years, I have asked to exit I cannot have any fossil fuel investment in my portfolio. And 20 years ago, my banker hated me because it was very complex to operate. And he was like, "You're my nightmare walking." And I was like, yes, big magic happened, but today it's highly feasible. So that's also your choice. I agree, we need to shift capital. It's not easy, especially right now with the price of oil rising so much and making so much profit. But you guys have your own destiny in hand, so just voice over.
Great. We've heard of their destiny. Apologies, sir. I've been told we've run out of time.
Sorry.
Can I thank our amazing panelists today too. Thank you so much for joining us all. It's been really good questions, really good discussion here on the panel as well. If anyone has any questions, please email us on the email that we did the events. Is it the events email? Is that right? The events email, the right email to Interim?
We'll follow up. We're going to send you
Yeah, we'll be following out emails, so please email us any questions or use LinkedIn or something. We'll get there. But thank you so much, everyone.
Thank you.